Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Dana Dioria, Co-Chief Investment Officer of Envestnet, to discuss why personalization of portfolios at scale can help to reduce costs and improve efficiency by automating the investment process. Dana, it is great to see you. As always, welcome back to Trade Talks.
Hi, Jill. Thank you for having me.
You got it. Explain to us how digital technologies are making it easier than ever to collect and analyze data on consumer behavior and preferences.
Yeah, so I mean, look, we're in a world now where, you go on the internet and you look at something and then, it sort of follows you around as you go, right? And certainly we all have had that experience of talking about something and then seeing an ad pop up for it. So, while there's certainly an extent of that you'd say, geez, is it getting a little too personal? Really what we're finding from surveys is that it's created this expectation of personalization in all parts of your existence, right? So if I can go on the internet and get an ad surfaced to me, how come my financial advisor can't give me a personalized, financial plan that incorporates maybe my social preferences or what I'm thinking about things? So, we're just seeing that the advent of technology in other parts of our lives that creates customization is creating an expectation that it would be the case in the financial services as well.
And speaking of personal preferences, let's talk about ESG and sustainability for a moment. It's become somewhat politicized in the US when we think about ESG, climate change in particular. Do you think there is, this will be a longer term investment solution when you think of sustainability?
I do. And I would draw a distinction. First of all, I think yes, 100%. But I think there's a couple of different versions of this, and sometimes they get conflated. So sustainable is really about just any type of investing where you might incorporate preferences. It runs the gamut. It's really can be from any part of the political spectrum. So, the original of this is really kind of socially responsible investing, which was kind of tied to religious groups, right? Catholicism and, Catholic bishops were proponents of this, and it goes often to, what we considered more, quote, left side of the spectrum to, environment, et cetera. But really, there's a lot of tie-in that people don't recognize between those. And, sustainable investing says, look, do I want to incorporate some of my social preferences in my portfolio? Now, a version of sustainable investing, ESG, is actually more about risk reduction and return enhancement potential for incorporating information that might be relevant. And that's really the job of any active manager, right? So we've known for years that good governance is tied to quality, which is a style factor that does outperform based on academic literature. E and S, environment and social, could be really just thought of as extensions of that idea. Is that, okay, if I have information on the governance of the company, I have some insight into how well that stock return is going to be over time. Well, the same may be true if I understand something about how they treat their supply chains, right? Or the people in their community, or if I understand, what their posture is toward the environment, because there's going to be regulation and social expectation around these things, and that could adversely impact the company.
What's a social legacy portfolio?
I use that term, and really what I mean by it is, you're going to see this mass transition of assets from, say, baby boomers to millennials, for example. So how does that transition look? It's a big question among advisors. How do we hold on to those assets, right? If I'm the financial advisor for those baby boomers, but they're passing it down, a lot of the generation accepting that fund transfer is not necessarily expecting to stay with their parents' financial advisor. What's something that the financial advisor can do to kind of keep them engaged, to keep that next generation engaged? One way to think about it would be think of something like a social legacy portfolio where we say, okay, what are your preferences? What are interests that you as millennials have? We know there's greater interest in sustainable investing among millennials. And can we create a portfolio that as we pass those assets down, we're able to affect that in that portfolio?
Let's switch gears a bit and talk about the market for a moment. While we've seen broader participation this week, how concerned are you about the concentration risk in those top 7 to 11 names, let's call it that have really been leading the market this year?
Jill, it's funny because it's everywhere, right? It's very high concentration. 10 out of 12%, right, is coming from just these few stocks, 7 stocks, 8 stocks if you throw on Netflix. And it's highly concentrated. It's highly top heavy. And you're kind of waiting for the shoe to drop, and it's not dropping, right? We just keep powering ahead, and now we have artificial intelligence, and how is that going to drive the demand for some of these stocks? Obviously, you have smaller companies involved in that, but really, it's these big, well-capitalized companies in the tech industry that are probably going to drive that. And so now you even have, another reason that you're seeing money potentially plow in. So it's hard to, kind of call what could happen, what could reverse that. A couple things. I mean, one, you're seeing these AI CEOs come out and say, hey, you should regulate us, right? Which is really interesting because, as a populist, there's probably a lot of people who would like to see that. But meantime, their 401k and their assets are being invested towards an index that is just sending money to these companies, right? So, but to the extent that regulators actually listen and start, maybe with that or antitrust or whatever it is, putting some constraints on these companies, that's one way you could see maybe a little bit of a headwind. And then another would be something like not getting a rate pivot, right? And even potentially rate increases where growthy stocks, that a lot of their value is in the terminal value, so it's discounted back. The higher that rate, the more you see that increase in rate, that impacts their valuation.
And finally, let's talk macro here for a little bit. What are your thoughts on if and when we get this recession that has yet to make an appearance? So
I'm reading more and more, some of the economists talking about the fact that maybe we're already in this recession, right? And, that we've been in this recession. And, there's some evidence, I guess, for that in terms of just some of these indicators are lagged. For example, unemployment is very much a lagged indicator, and that's been really the stalwart of this economy. So there's a chance that we've already, kind of gone into recession. You never know you're in recession until they call it after the fact. But to the extent we've had pretty good earnings season, GDP seems to be remaining strong. I would say, we're probably, bets are we might not be in recession yet, but there are enough indicators suggesting that we're sort of headed that way, right? Yield curve inversion, as indicators go, is pretty good. We do expect the lagged effect of monetary policy to start tightening, and also now we need to replenish the Treasury general account, which will also pull money out of the system. So second half of the year is good as bad as any. That we might finally see a dip into recession.
And finally, let's talk about asset allocation with this backdrop. If you're a money manager and you have to track your benchmark at least, right, and you're concerned about this concentration of those top 7, 8 names, how do you position yourself here?
It's a great question, because I think if you're in the money management industry, you can only have so much tracking error, right? The client can only handle so much of a difference between what their portfolio is doing and what the index is doing. So you really don't have much choice but to be kind of loaded up on these stocks. But I will say that, a tilt toward, something more like an equal weighted or something more value oriented, to the extent that we do see liquidity dry up a little bit, you would expect that value will outperform in a market like that. So, there's a fantastic thesis for investing in these growth companies. But to the extent you want to hedge your bets a little bit more than maybe what the broad market indexes are going to give you, a tilt toward diversified value, and certainly a tilt as well to defensive quality plays might be of use and interest to advisors.
All right, Dana, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.